Good afternoon, everyone. Just give us a moment, just get the slides up, and then we'll look to begin. Just bear with us a moment. Thanks.
Hello, Paul, and hello, everyone.
Hello there, Theo.
How are you today?
Better for seeing you as always, Theo.
Hello, are you there?
I am now, yes. Yep, I'm here now.
Yep. Today, I think Zoom plays some games to us, because in the live trading in the morning, I had some issues as well with the Zoom. So I think everything is fine now.
Good.
So we'll pass it on to you, ladies and gentlemen, admirals, and of course, us, Paul, myself, we would like to welcome you to this live trade, to this afternoon webinar. And I'm sure a significant amount of value is going to come after, like always, after Paul's webinar. Price action, it's what traders need to know, what leads the market, how the market moves based on price action, and all the other indicators we use and we teach. It's just pure an outcome, right, Paul, of the price itself.
Absolutely.
So without taking more from your time, I think you are now good to go.
Excellent. I'll just bring that up and hopefully bring up my slides, and everyone should be able to see them, he says. It's always a good start.
All right. I'll leave it with you.
Okay, super, everybody. I hope you can all hear me. I hope you can see the slides there. Okay, I hope that you're able to see them. Thanks for the introduction, Theo. Sorry, clearly we've got a couple of little challenges with Zoom there, but you know, such is life. We're all here now, and that's the important thing.
Yeah, sorry, Paul.
Yes.
If you allow me, I think that's the presenter's viewer.
Right.
So
just one
double
second.
check your monitors. Yeah.
Okay. Sure. That's all taken out. I'll just bring this back up. Probably got too many monitors on here.
Yes, exactly.
There we go. That's better,
the right
isn't
one.
it? There we go. Excellent. Thank you for that, Theo.
Thank you.
Super. Thanks for that, Theo. Hello, everybody. And what we're going to talk about today is session 26 of us focusing on price action. And actually, what we're going to talk today is a little bit of a, let's call it a dog leg with regards to price action trading. Namely, I'm going to talk about moving averages and how we can utilize those with price action to help us. You know, if you were a very, let's say if you were a purist, all right, if you're a purist price action, you'd say there shouldn't be actually any need for moving averages. But I recognize that for completely new traders, moving averages can help traders in a few ways, okay, as they develop their skill set. So hence why we're going to talk today about combining them with price action for yourselves. As always, I appreciate that we do have a broad range of experience of people who join us for our sessions, and so it's fabulous to have you all here. And it's wherever you are, okay, in the world. I appreciate these the English desk sessions, but it's a case of wherever you are in the world. It's great to have you here. You're very, very welcome, and we'll there's lots for us to share and talk about here today. So remember, here we are. We're Admirals, okay, a Forex and CFD broker, global presence and local support, licensed by a wide range of regulatory environments across the globe, providing competitive spreads on the most popular trading products and allowing you to engage with markets utilizing both the MT4 and MT5 platforms. If you have any more questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. So, what we're going to talk about is, we're going to talk about a great deal of price action, and in particular, as I said, the moving averages, but we'll focus on more of that in a moment. For those who don't know me yet, if you're just joining us for the first session, my name's Paul, right? I've traded for many years, looking to, I've traded for funds and for clients, Primarily, I look to focus on trading FX indices and commodities, and I'm a trend trader for my longer-term trades and a reversal trader for my short intraday trades, all of which is relevant to price action, all of which can be helped by moving averages as well. So, as always, as I said, we were doing this series as a way to actually help new traders understand price action. How do they go about utilizing it in their trading? Because we appreciate that, for many traders, when they start out, it's quite easy for beginner traders to be intimidated by the amount of knowledge that's required to be able to analyze markets. However, and hopefully you're learning that from this series, is a little bit of education, a little bit of understanding of how candlesticks are formed and what they tell us, then it becomes easy to analyze, understand markets, and engage with them. So each Wednesday we've been building upon each particular previous session so that we're able to share knowledge and understanding of how you can go about engaging with markets utilizing price action. And if you are, as I said, joining us for the first time, price action trading is just a very basic means of market analysis using price movement over time, which is popular with both retail and institutional traders. And it's typically focusing on price action over the last 3 to 6 months, but also respecting kind of longer term price movements and also intraday price action. We will focus mostly on kind of longer term trading, although I'm going to do a session in about 3-4 weeks time on price action and intraday trading. So we cover the full gamut of how you can engage. But what we tend to do is look at focusing on the longer term trading, and the reason for that is simply that we appreciate that this is a guide for many new beginner traders. This is the opportunity to basically look at this, take your time, understand it, learn it. We recognize that you might not be as a full-time trader sat in front of your charts all day. You might be actually trading around family commitment, a job, a business, other lifestyle commitments, etc. And so end of day trading or trading in the start of your day, on longer term time price charts, might well be the way you're operating. So that's what we will focus on. But I repeat it every week that understanding good price action and being able to read it and recognize it, just like kind of like a new language. Once you understand it, well, you can utilize it anywhere. And even though that slide says it's a basic means of market analysis, just because it's basic doesn't mean that it's that it is it is lacking in some way. If anything, its strength is in the fact that it is quite simple and it's quite basic, right? In that you're able to once you're able to learn the new language, this new language of reading price action, well then as I said, you can utilize it in any time frame and in any indices, and it's a fabulous foundation for you to have in your own trading journey. We have covered an awful lot in this series so far, and as I say every week, for the new traders, I try and focus a little bit on some of the hard skills. So things like sort of trading setups like engulfing candles, star formations, pin bars, inside bars, false breakouts, rejection candles, etc. But also on some of the soft skills that you want to bring to the table as well, about preparing for opportunity in markets, understanding the importance of having good routines, utilizing checklists. All right, how do you manage your trades once you're in them? How do you review your trades to improve your performance? These are all the kind of soft skills which, when you start out, you might not recognize as being that important, but I assure you, the longer you trade, the more that becomes important to you. So, I talk about how, when you are price action trading, we want to have just a very simple routine to start with, all right? We've been through a fair few of these steps, but, I repeat them every week. And the reason is because every time you see and hear it from me, it's almost like it embeds it. Okay, the more you hear it, the more you're likely to sort of embed it as your own way of operating. Namely that whenever you open a chart, doesn't matter what it is, all right, whether you want to trade Bitcoin or gold or the S&P 500 or euro dollar, when you open a chart, first thing you should be doing, defining your levels of support and resistance, monthly, weekly, daily. We do that because markets remember them, okay? Markets remember them, and markets, these are areas where the market is likely to have to make a decision. Either they become levels under which, which might be a support, or they might become levels which become a target, or it becomes levels at which price might make a reversal. So, these are areas that are of relevance and importance to us as price action traders. What we also then want to do is define if there is a trend. And I say it every week, good trends leap off the chart at you. Right? Don't feel that you have to force it. If you find yourself forcing it, the likelihood is it probably isn't there. The challenge we have is, we want to trade trends ideally as a new trader with price action, but the reality is markets tend to only trend about 20 to 30% of the time. So that's why I said good trends leap off the chart. You don't force it. Don't feel that you have to really squeeze it in. You don't. Because what we are looking for is to see, well, if there is a trend, well, then, in an uptrend, we want to be a buyer at support. In a downtrend, we want to be a seller at resistance. So we're interested in seeing how does price react at key support and resistance levels. Sometimes those levels are, the horizontal levels we've drawn in. Sometimes they may be big round numbers. Okay, so in gold, okay, over the last week or two, people have been looking at how it traded around the $2,000 mark. All right, big numbers, big 000 numbers, or it might just be minor levels of support resistance that you see as the market prints as it carries on in its journey. What we're interested in is, when we are at those particular areas where markets are going to have to make a decision, well, we're looking to see are the price action triggers there at those particular levels that might give us an opportunity to sort of get on board, to take to do our business and get involved in that trend. So, when we see price action triggers, things like pin bars, engulfing candles, key reversals, star formations, etc. This is what it gives us a trigger as an opportunity to join that trend. It's also worth knowing step 5 is it part of a bigger chart pattern? If you're in an uptrend, maybe there's a nice flag pattern there that is also showing up that is possible to be traded, or maybe you're about to take a trend, but actually it's part of what might be, let's say, something like a head and shoulders pattern, which is a reversal pattern, whereby you just might want to be a little bit wary. So, just 5 simple steps. Start with a simple routine for new traders, just to make sure you're doing the right things. And we'll look at some of the other steps in future sessions. And we talked, I think last week we talked about trading indices, but there are an awful lot of fabulous instruments you can get engaged with, utilizing price action, utilizing Admirals and their MT4 and MT5 platforms. Tend to focus on an FX world, the dollar index, and those 28 major pairs, the crosses between the major pairs. You can read them there. But also the indices, okay? Those big major American indices, S&P 500, Dow 30, NASDAQ, and then, globally, things like the FTSE 100, the DAX, Nikkei, the ASX 200, okay? They are all relevant, right? All able to be engaged with price action and are all available for you to trade with Admirals. You might want to look at things like commodities, okay? Oil, gold, and silver, and others there. As I said, gold has been very eventful, shall we say, over the last few weeks, which we'll look at. But then there are still some traders who will want to be focusing on trading things like certain equities, right, which have been interesting in terms of their price action recently, but also even some traders wanting to trade cryptocurrencies like Bitcoin. So, as I said, price action is like a language, okay? Learning, French or German or Spanish, okay? Whatever it might be, okay? It's almost like that. It's like learning when you learn new music, okay? If you start taking music lessons, you have to learn and understand what all the musical notes are and how they go together to make a sheet of music. It's the same with price action, all right? And the only way you can do it is to practice, open up charts, build profiles, all right? And just start to go through and just practice doing your analysis. The more you do it, the better you'll actually become. There are no magic beans that you can get hold of there. Okay, there's no magic lotion that you can cover yourself that makes you an ultimate price action trader overnight. I wish there were. I'm sure someone would make a fortune from trying to foist that on people. The reality is that you just have to do the work. Okay, just do a little bit of work every day, looking at charts, all right, understanding price action, going through that routine. The great thing about the Admirals MetaTrader platforms, both 5 and 4, is once you've drawn on those levels of support and resistance, once you've created profiles and templates, they're there. So it takes a little bit of time at the start to get yourself set up, but once you're there, it becomes very quick to actually just keep on top of doing your analysis, working out what those instruments are doing, and finding out if there's a way and an opportunity for you to engage with them. So, with regards to all that, let's talk about moving averages. Now, it'd be interesting to know, those of you here joining us today, okay, those people joining us today, how many know what moving averages are? How many of you use moving averages? And if you do, in what particular way do you use moving averages? So you can put yourself a little comment there in the chat box, all right? But for many new traders, moving averages are quite a simple and popular indicator. And we'll take a look in a couple of slides' time about as to why they are popular. Okay, well, she'll take a look at that particular why. But very often what we find is many new traders, I would suggest that they use them inefficiently in their trading. So today, we'll take a little bit of a look into moving averages, discuss them, how you can utilize them more efficiently in your own trading, and look at how the relevance that has to sort of utilizing price action. So as I said, sometimes moving averages get a bit of a bad name, all right, because basically people utilize them wrong or have the wrong expectations of them, but actually they can be enormously useful for traders if you use them in an efficient manner. So, as it says there, many traders start the trend journey beginning using moving average indicators, right? And what is it that makes them so popular? Well, for starters, they're popular because they're a visual trading tool, which we'll look at in a chart. And the reality is, still to this day, most traders are male, and most males are driven by visual cues. Will that be right or wrong? Okay, that in itself is a debate all of its own that people can have. But that's just the kind of the nature of the beast in terms. And what it allows traders to do is it also allows traders to view smoothed out data, especially when you're starting to, as I said, you're on your start of your trading journey. And it might be a little bit overwhelming. You might be trying to understand everything. You might not necessarily be able to read price action as clear as you'd like. Sometimes moving averages can help or appear very helpful. So Alfred says, I use them second confirmation signal, long or short, 50 SMA, and it's also, is the SMA ascending or not? Also the 20 SMA. So that's very good, Alfred. Okay, you're using the 20 and 50 SMA on the 30-minute chart. Fabulous. Well, maybe we'll have a little look at that. Okay, when we switch across to the live charts. I appreciate you sharing that with us, Alfred. That's really good. Thank you for that. Okay, and you'll see that probably some of the things I'll talk about may well resonate with you on that. But as I said, is that lots of people are popular because they're a simple visual tool, and also it allows traders, okay, to effectively view smoothed out data. So that's a moving average of the last 10 periods. So a 10 moving average, 10 period moving average is effectively taking the closes of the last 10 closes, adding them up, taking an average of it, and then plotting it. So the clues in the name, ladies and gentlemen. It's averages that are moving. So fancy that. So this is, as I said, moving averages. And not unsurprisingly, the bigger the number, whether you've got 10 or 50 or 200 or 600, I've seen people using 800 period moving averages. The more data that it goes in, okay, the slower that moving average is in terms of the slower it turns, the slower it moves. Whereas the faster the number, or the lower the number, the closer you'll find that the moving average is to the actual price. And that can be a blessing and a curse. Okay, as you hear me say all the time, with any kind of trading setup or trading indicator, there is no perfection. Okay, there is no perfection. All right, they all have their pros and cons, and it is about you understanding, what are the pros? Does those pros resonate with you? Okay, in your style of trading? Are the cons? Can you live with them? Okay, do you need to find ways to mitigate them, or are they ways that will basically encourage you to trade without discipline, etc. So as I said, there is no holy grail. There is no perfection. All right, it is about understanding the pros and cons, and then combining, okay, melding together a couple of ideas that resonate with you, that allow you to build a simple method that allows you to sort of trade effectively, session after session after session. So what we tend to find is, with regards to moving averages, that they can be very helpful to help a trader gauge the direction of the chart, the momentum, and also the strength of the trend. And these are elements that we'll talk a little bit more about. Not unsurprisingly, okay, this is, what's this? This is an hourly chart on cable. Remember what I was saying is that step 2 is all about looking at, is there a trend in place? Okay, and no trend is in a straight line. Okay, But as I said, a good trend should leap off the chart with you, kind of, in terms of an uptrend, printing higher highs, higher lows. Okay, that's what we want to see. But also, moving averages can help with that. Okay, in terms of just showing that, there is definitely, that trend is in place. And as I said, there's also an element of the momentum. How strong is that trend? Okay, is the momentum there? Is it waning? Is that trend strong, or okay, or is it a weak trend? All right, and that's all okay. That's all just giving you feedback that allows you to make your own particular trading choices. And we're going to look at that a little bit more in a few moments' time. As always, there's a few questions to be asked, okay? Or there's a few questions you might be asking, right? There's a few questions I hear a lot of. First type is, what type of moving average should I use? You will find these days that, you go onto any trading platform, that you'll find that there are many, many options in terms of, what type of moving averages should you use. There's all sorts, okay? There's weighted, there's offset, okay? There's particular individual ones that are linked to specific traders, etc. There's all sorts. What I tend to find, is, people tend to focus on one of two, either using a simple moving average or an exponential moving average. So you might see it as an SMA or an EMA. So Alfred, before, he said he uses SMA, okay? I myself use SMAs as well. And what's the difference? Well, in simple terms, speed. Okay, there'll be people who will think SMAs are the best, simple moving averages. There'll be people who think exponential moving averages. And as I said, you could debate that for the rest of your days if you particularly wish it. What we're really trying to understand is that exponential moving averages, they give more weight to the most recent price action. So when price changes direction, an EMA will recognize this sooner because it gives more weight to the most recent price action. That can be very helpful. However, the simple moving average, which moves slower, will keep you in trades longer when you are trying to follow a trend. So in this particular chart here, what we've got is just quite simply hopefully you can see it, we have a 20 EMA, okay, which is the dotted blue line, and also just the standard 20 simple moving average. And what we can see is that basically, okay, the dotted blue line, it turns faster than the 20 simple moving average, all right, at this reversal point. And for those of you who are always looking for trading ideas, there might be a simple trading idea in there, okay, for that you might want to take away and sort of work upon yourselves. But as I said, EMAs tend to be more reactive to price turns, okay? An SMA the trend will tend to just go a little bit longer. So they both have their pros and cons, okay? They both have their pros and cons. Neither one is perfect. It's about what can you simply use. And the thing is, what you'll probably see is that for an awful lot of the time, okay, there, the EMA and the SMA, there's very, very little difference in them. There's very little difference, all right? And that's not always the case. Sometimes there might be a bit of a turn and a gap, but for a lot of the time, there isn't that much of a difference, okay? As I said, I see lots of people at trading conferences all wanting to, sort of, plant their flag that, their style of moving average is the best one, all right? And the reality is, none of them are perfect, okay? It is about what can I utilize and how do I utilize it, which is what we're going to come on to more in a moment. Because then, the next best question becomes, well, what's the best period moving average for me to use? And as it says there on the slide, it's an age-old question, one that's been debated down the ages, and you could spend your life testing all sorts of combinations. And I know of many traders who have. I know many traders who spend their weekends literally testing all manner of moving average combinations. And and if you have the skill set, and you've got the sort of intention to do that, and you've got the interest and the the kind of the desire to do that, well, then you knock yourself out, okay, fill your boots, okay, get stuck in. My suggestion is that you stick to the kind of commonly used moving averages. And why would I do that? Well, it's because they become a bit of a self-fulfilling prophecy. And like any self-fulfilling prophecy, once again, there can be good and bad to that, all right? But as I said, you can spend your life trying to find the perfect moving average for each instrument, and maybe that becomes your life's purpose. Personally, I'm just utilizing it as a way and a means to help me with my trading decisions. And it's actually, I want to focus on my trading decisions. I want to focus on actually getting into the trade and managing what the market's, what the market's offering to me. And I don't, I don't have any particular desire to find the absolute perfect moving average, okay? Because I think actually markets change, and I think if lots of traders try to over optimize their setups, okay, their trading algos, their setups, their indicators, etc., to try and over optimize to make them perfect, when in fact all it is it's just part of a bigger decision making framework that is there to help me make a decision. Am I going to be a buyer? Am I going to be a seller? Am I going to sit in my hands? That's it. Keeping it as simple as I possibly can. But what you will find, okay, for the very popular moving averages, is that quite often you'll see people will use around about the 10-period moving average for shorter term trading. If price is respecting that, that is giving you an indication that that trend is strong, whether it be an uptrend or a downtrend. Very often, it's what I use myself, like a 20-period moving average is almost like a filter for the short-term trend. It's just giving you an indication of where there's kind of maybe where there might be strength or where there might be weakness. And then very often, and I will use a 50-period moving average. And this, as it says, I ideally use for the medium-term trend, or as kind of a bit of a definition of fair value. And I will look at that more in depth as we go through the slides. And then kind of a longer term period moving average, 100-period, 200-period that I use, right, and use for identifying the long-term trend. So, as I said, there's lots of different ones you can use. You can refine that to your own heart's content, but generally, I tend to use the 20, 50, and the 200. All right, they are pretty standard. Right, as I said, there's no perfection. It's about utilizing them as a tool to just help me in my decision making. That's all I'm looking to do. So hence why, if you see on my charts, you'll see I have a blue 20 SMA. All right, I use blue for that. I have a red 50 SMA and a green 200 SMA there. Okay, and just this is kind of this is probably a finesse, I would say, is that if you look at my charts, definitely the 20 and the 200, they are the sort of the thinnest. Okay, the thinnest moving average that you can choose in terms of how they are displayed. I have the 51 a little bit thicker, but mostly I want them just as small and as thin as possible. What I find quite often is new traders, they select the moving averages and select them as basically as the thickest line on their particular chart in terms of the way it's displayed. The challenge I think people have with that is that their eyes start focusing on the moving averages rather than focusing on price. Price is king, okay? Price is a leading indicator. The moving average is still a lagging indicator because it's working off that OHLC data. So it is always lagging. So what you want to do is you all want to be focusing on price. Remember, moving averages are almost like in the background to help you with your decision making. Okay, don't get caught up in just finding that you just need to and want to focus on the moving average itself over price. That never works well, ladies and gentlemen. That's not a smart way to operate. So, how do I use moving averages in my trading? How could you utilize them? Well, as it says, there's many ways for you to use moving averages for identifying trade opportunities. So why don't we have a little look at a couple of them? One of them in particular is moving average crossovers. Now, this tends to be a very popular trading strategy with new traders because you basically place a trade, right, when a faster moving average crosses a slower in the direction of that particular cross. It works well in trending markets, but very poorly in consolidating markets. So here, where I've got there, there is the 20-period moving average, okay, crossing the 200 period, the slow one. Then when you cross it, people would just be looking to, when that is there, they'll be looking to be buying there and stay in that particular trade. And lots of new traders like to utilize that because it's quite simple, it's quite visual. And what happens is, this is what people get sold, all right. Namely that, as I said, when the faster moving average crosses a slower one, you buy here, okay, and then you stay in that trade until, as you can see there, the moving average crosses back beneath the slow moving average, and that's where you exit. This is where you've entered, this is where you exit, and and the move between that, that is all the profit that is possible for you on your particular trade. And everybody looks at that and thinks, this is fabulous. This is absolutely wonderful. This is brilliant. This is all I need as a trader. But remember what I said, earlier, is that moving averages work well in strong trends like that. But pretty much everything works well in a strong trend. Okay, you don't have to be a rock star. Okay, when it's when you're in a very, very good strong trend. The problem with utilizing moving average crossovers is that when price is in a bit of a channel or in a bit of a range bound, well, then invariably what happens is you're constantly basically getting chopped up. You're getting whipsawed. Okay, that's how people describe it. You're getting whipsawed. So all the profits you'll have made on the good trend, you will give back during periods of consolidation and range bound. And so that's why personally, I don't use a simple moving average crossover as a trading tool. I might use it as a filter for other trade setups, okay, but as a general rule, lots of people when they start their trading journey like to do that, but actually, it's not, it works very well in good trends, but as I said, you'll get chopped up in poor trends. So it's not, I wouldn't utilize them there for that. What you'll quite often see in the media, though, and the media love this, if you're watching, some of those financial media, is that, they will talk about something called the death cross, which is where the 50-period moving average crosses the 200-period moving average to the downside. Okay, so that's there, the red 50 crossing the green 200, or a golden cross where the 50-period moving average crosses the 200 to the upside. Okay, and that's what they'll talk. You'll sometimes hear about them talk about that in the media because it's nice and it's simple and it's easy. But as a trading rule, I personally don't think it's terribly useful or terribly helpful at all and stuff. Okay, it's normally, as you can see here in that particular case, where where the death crosses occurred. Well, actually, the reversal happened up here. We've already been in a strong trend. By the time it crosses, actually price in that particular case is already taking a reverse on it. And by the time, we cross here in the golden cross, okay, we're buying in here, but the reversal was down here. We've already had a very nice long trend already before. And so, as I said, moving averages like that, they are lagging indicators. Price is always king. Price is always key. It's about utilizing it where we can as a decision support tool. So, where moving averages can start to come into being very useful for you is, I see traders using moving averages as their trailing stop loss. Okay, so it's a fine example of where moving averages can help you, all right, and have a simple way to trail your stop in order to stay with winning trades for longer. And depending on whether you're a short-term or a longer-term trader, you can place your stop loss behind either the 20 or the 50 or another particular moving average. So, if let's say, if we're basically bought this particular breakout here, breaking up there, and our initial stop loss might have been beneath the lows here, okay, the low of that consolidation. Well, then what we might do is actually have our initial stop just behind, let's say in this case, the 50-period moving average. Let's say you have that, okay, bosh, and it goes, and actually, you're taken out here. Now that is where a moving average can be very useful, and it can be quite almost mechanical. And it's almost something that, for those of you who want to sort of go down a route of, programming indicators or EAs, that's the sort of thing you can do. You could also, as I said, follow on the 20-period moving average, but remember the likelihood is that price is going to get, ticked on that sooner and earlier. So you have to take a little bit of work and understanding on what style of trader you are. And also, as I said, you're a short-term trader or a longer-term trader, depending on where you'd like to place your stop loss. So, as I said, it can be very useful. It's a simple way to do it. It's mechanical in the sense that, you don't move it until the moving average, okay, moves. But, the other thing element is that, you might be getting out here, taking out when this trade closes completely the other side of the 50. But the top is here, so you're always going to give back some of the trend. Just always remember that. You're always going to give some of the trend. One of the other good ways, and one of the ways that I particularly personally utilize it, is using moving averages as areas of dynamic support and resistance on your charts. And this is one of the reasons for using the most popular moving average period in your charts, is because of their self-fulfilling nature. There are lots of traders, lots of buy and sell programs, lots of algos placing trades around popular moving averages. And this provides an area to join a trend trade on one of its pullbacks. So once again, we've got the 20, the 50, 200 here. Price has been in a downtrend, but watch what happens when it pulls back to the 20. It puts in there, there's a bearish pin bar there. There's a bearish pin bar there, okay? There's another pin bar there. There's a couple of pin bars there, okay? You might also say there's another one there. There's a bit of an engulfing handle there, okay? So, what we see is that, that traders, whether they be manual traders or whether they be algos, will utilize certainly things like, I noticed an awful lot around the 20-period moving average. A lot of buy and sell programs will trade bounces off the moving average. And that in itself is actually a very, very simple way to combine price action and moving averages. Utilizing the moving averages, identify the trends, wait for pullbacks, and then see what is the price action like once price pulls back to particular moving averages. Remember, these are areas, as we say, we're looking at them as dynamic support and resistance. It's dynamic because those moving averages are constantly changing. Let's say, a horizontal, level of support and resistance is always there. It's static. A dynamic one is constantly changing and updating as we go through the trades. And this is definitely something that you can utilize. And it's very, 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 very simple, okay? Very simple. You're identifying if there's a trend, waiting for a pullback to the moving average, whether it be the 20 or the 50, and then look at how does the price action play out there. It kind of meets that kind of little routine we talked a good few slides back, and just keeping it quite simple like that. Just keeping it quite simple, all right? You're looking to trade with the trend on a pullback, with the trigger being price action off a level of support resistance, and in this case a dynamic level of support resistance. And that can be the basis of a very, very simple but very effective trading method. And as you increase and improve in your reading of price action and reading of markets, is that one thing you can do, and it's one of the other things I utilize myself, is I use the 20-period moving average as a bit of an early indicator that there's a trend change, is definitely happening. And it can be really useful to help you confirm that. And what I talk about is watch how price reacts around the 20-period moving average after recent highs and lows. And that itself, it can be the basis of a trading method of its own, right? And that, it's one of the ways I like to utilize it. This particular example, we can see we did have a cross here, and prices come back to it, bounced off the 20, comes back. It eventually does bounce off the 20. But what the important thing is that 20 is acting as support. It's acting as support here. And actually what we get is we get a really lovely double top, which is a first element that, this trend is coming to an end and price might be ready to roll over and reverse. But then what we see is, price comes down a little bit and then price drives its way back up into the moving average. And what we see is, I'm just going to clear this, is, where the 20-period moving average was acting as support, well, now it's flipped. And now it is basically operating as resistance. And furthermore, the 20-period moving average has turned, okay, from going up, it's rolling over. And what we're seeing now is we're starting to get basically lower highs. We're also getting, its wicks. Price can't get up above the 20-period moving average. This is just confirming this double top has occurred. And now we're looking at, well, all right, okay, we should be getting ready to be short. And in this particular case, you can see that there you go, the price collapses and it slices through the 50-period moving average and goes all the way down to the 200-period moving average. So this is, as I said, this is one of the ways I like to use 20-period moving averages. You're watching that, okay, it can just help confirm that a reversal has occurred, the price is about to roll over, and that in itself might provide the opportunity for a trade in the new direction. So we've got a little bit of time left, so let's go and switch across to the charts. Just remember, to conclude, price action is just a very simple way of analyzing markets, utilizing purely price action, and price action is king. We're looking for price action triggers at significant price levels, prices, or zones, and that allows us to build a simple price action trading plan. Moving averages are a popular trading tool for new traders because they're a visual indicator and it helps smooth out data. It's important to understand whether you're going to use exponential moving averages or simple moving averages. I use simple, but there's no, they are much of a muchness. They both have their pros and cons, all right? I also suggest that it's probably best to use just the common period moving averages, all right? They become a self-fulfilling prophecy. And with regards to using them for trading, we should avoid moving average crossovers. That's not to say that a moving average crossover can't be part of a filter as part of an overall trading method, but just simply trading moving average crossovers is a challenging way to operate. But moving averages are useful for helping confirm trends and momentum. They can be useful for helping confirm reversals in markets, like we saw there with the 20-period moving average. Also can be used as a guide on where to place trailing stop losses, and there's also places to enter into trending markets when a market in a trend pulls back to a dynamic level of support resistance and the price action shows you that it's about to bounce off there. That in itself is a wonderful opportunity of its own. So why don't we have a little look at them on live markets for the last few moments. Before we head over to the live charts, just remember that, to put us in the diary for the next session, which is on Wednesday, 5th of April. And what we're going to look at there in session 27 is how to make the best use of the daily chart with price action trading. How do we utilize it in terms of support resistance? How do we utilize it in terms of identifying a trend? How can we utilize it in terms of, what we might be looking for in terms of trade setups? So we'll talk about what's so important about the daily chart. How do we best use it? How do we combine it with price action to give ourselves a bit of an edge? And that is next Wednesday, 5th of April, London, 2 p.m. I hope you'll be able to join us for that, all right? And we will be able to see that. Alfred said, is it possible to get this presentation? And what's happened to Alfred is this presentation is recorded and it goes on to the Admirals YouTube channel. So probably in the next day or two, you'll see it on there. It'll also be on the Admirals Facebook page there. So if you're already subscribed to the Admirals YouTube channel, then you'll get a notification. If not, then just go on to YouTube, search for Admirals, subscribe to the channel, and as I said, you'll get the opportunity to review this. And not only this, but all of the other preceding 20 videos or so of this particular price action series, you'll find that they are all there for you to enjoy at your own particular leisure. If you want to contact us, you can see, do so. Okay, you can see there's an email address there. You'll probably also get a little feedback form after this session. It'd be great if you just take a moment just to put down your thoughts. Hopefully this session has helped you. But also, if you've got ideas for things you'd like to see me cover in future price action sessions, then we will gladly hear that. Okay, so if you'll take the moment just to fill that in, that would be very, very helpful. So why don't we switch across to the charts? We've got a couple of minutes left. Let's have a little bit of a look and stuff, and see what's been going on, and actually how moving averages are helping on those particular charts. So just bear with us one moment, and we'll switch across to the charts. Okay. So I am hoping that you can still hear me, hoping you can still see me, hoping that you can hear us. Okay, so here we're on the Admirals platform. What have I got up here today? So I've got so this is just the euro. I have a profile for the euro, okay, here, and and it's basically the euro across those majors. Remember what I was saying earlier about price action? So I've got up here, we've got the euro against the US dollar, the euro against the sterling, the euro against the Aussie, euro against the Canadian dollar, euro against the Japanese yen, euro against the Swiss franc, euro against the Kiwi dollar, and then because it's euro, I've got the DAX here as well. So, the good thing for me is that, I have profiles set up for all the major currencies like that. And, it allows me at a quick glance to basically get a snapshot of, of whether there's a trend in the euro pairs, okay, whether there's, strength or weakness in there, and actually how I could look to utilize that. So, let's have why don't we have a little look at let's have a little look at euro Canadian dollar on the weekly. Yeah, this is great. So this on the weekly chart. So excuse me, this is the weekly chart, the euro Canadian dollar. And hopefully what you can see here is, for the last, in fact, for about nearly 18 months, even more, the euro Canadian dollar was in a great trend. Okay, price was making lower lows. Okay, you can see lower lows there. And also it was, you can see the sort of the moving averages. Remember, we talk about price was beneath the moving averages. There's the 20, there's the 50, there's the 200. Okay, and that in itself just confirmed. Okay, gave us a great confirmation that that we're in a trend. And hopefully, what you can also see is that quite often, I'll just clear some of these here, is that price, as price was in a trend and pulls back, well, then basically it would bounce off the 50 period moving average there. Okay, that's a bearish engulfing key reversal pattern there before it ran down, came up to the 20, put in a a rejection candle, a pin bar. The price ran down for the next few weeks. Price basically pulled up and then it rolled over again. Okay, and we can see that that's what was continuing in that up until let's zoom in here. Okay, up until at the end of that great trend, what we started to see was one, here was a bit of what we call a false breakout, which is so, and then price rallied its way up. It broke sort of the structures, the fractal indicators, in terms of above price, and then what we saw here was, during these trends, okay, what we had seen is that the 20 period moving average had been acting as resistance. Remember, we just talked about this, and what we saw here was, we had a false breakout followed by a tap of the 20 period moving average, and then basically price put in this huge big, it's a shift candle. It's a big candle. You might call it, I'd call it a domino candle, a shift candle, an engulfing candle. But momentum had shifted. That downtrend was over. And then what happens is we see price comes back down to this 20 period moving average. Remember, I was saying the 20 period moving average, which had been acting as resistance, has now flipped and is now here, becomes support. And so now what we've started to get is, the price is moving over. We then slice through the 50 period moving average, and then it bounces off it. And actually price is just basically goes up. Where does it travel up to? Travels up to the 200 period moving average here, where it basically rejects for a while, and price falls away. And I mean, remember, this is a weekly chart. So actually, as swing traders, there was trades there in themselves, and that particular trades on the way up, there's trades on the particular moves. And now what we've seen is basically price has got through that 200 period moving average. Price has flipped. It's closed it, it closed the other side of it. It's come back down to it. And it's confirmed that we were in a bit of an uptrend there on a weekly basis. So, just even on that, there's over a couple of over a couple of year period, there's lots of examples there of price being in trend, price reversing, price running and utilizing the moving averages, as I said, as kind of dynamic levels of support resistance, confirming good trends, but also when that trend is about to flip and reverse upon us. And I think I want to have a little look at, I think euro dollar. Lots of people trade euro dollar. Okay, this was sort of most of a good few months, okay, of a good 6 months or so of last year, where we had dollar strength and euro weakness, and what we had was we could see that price had started to get itself into a trend, but price would pull back to the 50 period moving average, put in a bearish engulfing. Okay, it fell, came back up to the 20 here, put in a pin bar rejection candle, and it ran. Price came back up to the 50 here, and it looked, like maybe the trend is over, until it puts in a bearish engulfing candle there, and we're off again. Here it comes up, and that puts in a 3-bar reversal, and away it goes. Comes back up here. This, effectively is like a 3-bar reversal again. It drops its way, comes back up, puts in a pin bar there, followed by a really strong follow through before it falls away. Okay, comes back up, and then a bit like on the EuroCAD, what we see is that basically price starts to flip, and the 20 starts to turn from being resistance to being support, and we break through. That's the end of that trend. But look at that from effectively from February to October. Okay, what's that, about 8 months, 6 to 8 months? That was just in a downtrend. Okay, the moving averages were very clear. The 200 period moving average was just very clear. The 50 was beneath it, as was the 20, and price for the most time was beneath the moving averages, apart from those periods where it pulled back. Okay, and even some of those pullbacks would have looked like flag patterns, okay, or counter trend line trades. Okay, just drawing them in very, very quickly. I would be a bit more accurate. Okay, but remember what we said. That's you can look at and see if that's a bit of a chart pattern. And so, for many traders, okay, and I know people who just effectively trade price action bounces off the 50 period moving average. Once that 50 period moving average has chosen its direction, it was very clearly in a downtrend there. Every pullback to it that is basically rejected or bounced, okay, with the price action, that's an opportunity to just trade and join the trend. Very, very simple. Okay, a little bit of an element of visual, but it's just a chance to be able to combine price action and moving averages together to give you an opportunity, all right, of how to just trade with and join an existing trend, so that you're in a position to as I said, trade in the direction of the trend and get yourself on board some good trend trades. You know, as I said, markets don't trend as often as we like, and so when they do, well, what we want to be able to do is to be in a position to sort of try and ride that trend, to surf that wave. If you're a surfer, okay, I'm a terrible surfer, but you know, the analogy is works and is clear. So there you go, ladies and gentlemen. Unfortunately, we've run out of time for today. As I always say, time flies when you're having fun. And hopefully that session today has been helpful for you, has been particularly useful. It's given you, if you're a completely new trader, it's given you a way that you can effectively utilize the moving averages along with price action to basically help you in your decisions, but also give you ways to sort of trade and engage with markets. And also, if you're a bit of an intermediate trader, just confirms, okay, that how and why you should be using moving averages, and actually how you can build simple trade plans around it that allow you to engage with markets and trade in the direction of the trend. So, as always, I wish you the very best of success in your own trading, ladies and gentlemen. I hope you have yourselves a fabulous trading week, and I look forward to speaking to you soon on our next session here for the Paul's Price Action, Ultimate Price Action.